Hello, everybody. My name is Michael DeGioia, and welcome back to the Trader Newsroom. This time, we're going to be talking about recession fears reemerging. And my name is Michael DeGioia, Director of Education here at Trader, and I'm joined here today at the Nasdaq market site with Jill Molandrino, my regular co-host, but actually in her home turf this time around. Jill, thank you for having me.
And thank you for having me back on the show again. It's great to have you on our home turf. I mean, the first time that you have been back here since March 2020, at least. It's good to have everyone in our home in the heart of Times Square.
Yes.
New York City definitely is a different vibe than you and I, either at home or somewhere around the world, like the Where's Waldo of Trading, which,
yes,
by the way, is
I am certainly the Where's Waldo of Trading. I'm always bouncing around, and it's really great to see New York City mostly open again.
Yeah.
And to be back here, last time we were back here was pre-pandemic.
Yeah.
And everything's come back to normal. And but let's jump right into the news and talk a little bit about what's going on today in the markets. Jobless claims have come in the lowest they have been in months. 232,000 was the latest drop in jobless claims. Will that increase the risk of a rate hike at the next meeting that's coming up here in September?
You know, it's so interesting. This is the most strange recessionary environment, if you want to call it recession, because of what we're seeing. The housing market's still strong at the end of the day, despite the data coming back in. And of course, we're seeing it with jobs as well. And I think that's really what's stymieing the Fed, if you will, because the market still remains strong. And I think when you look at the JOLTS report in particular that we saw on Wednesday, for every person looking for a job, you have two available. But Mike, the question I ask myself is, are these the jobs in services and hospitality and restaurants where a lot of people flee during the pandemic to get into other types of jobs, whether it's the tech sector or where they have a little bit more autonomy and don't have to be in specific physical places and deal with the public, of course. So it makes you wonder, what are the types of jobs that are open? And I think that's what's really making it challenging for the Fed, because they're going to have to continue to raise in order to get this economy back under control. And it's so easy to see the headlines and be on Twitter and, you know, Powell's this and the Fed's this and they don't know what they're doing. We're managing a multi-trillion-dollar economy, and there's a fine balancing act. And when jobs are strong, housing market's strong, consumer spending is still strong, consumer confidence is still strong, it makes it, you know, really difficult, because the only thing that is really weak is the inflation data. Other than that, it's not that bad. Yeah,
I mean, I'm going to sound a little bit like I'm talking about Star Trek here, but the Fed's prime directive is, number one, to manage and control inflation, right, and to make sure inflation doesn't get out of control. And then number two, to make sure that the economy has high levels of employment. And clearly, we're seeing from these job numbers that the employment level is pretty solid, and the economy seems pretty solid.
Yeah.
So what it pretty much does is it encourages the Fed to possibly increase more, because if you go back to your days of 101 education in economics, it was you need to have 2% above the rate of inflation to cool inflationary concerns. So that means that we're still very far off. They have a lot of ground to make up.
Right.
And they're going to take every opportunity they can get to kind of catch up to these kind of somewhat rampant inflation.
And they definitely will. And you don't want to have a repeat of what happened in the late 70s and early 80s, where they changed course too quick, right? Because when you have interest rates move higher, it doesn't correct it just because the headline hit. It takes a number of months for this to work through the system. So you don't want to have that risk where you reverse action too quick and then inflation went even more out of control. So I think they're being very deliberate. I don't think this is a surprise to the markets. The messaging really has not changed, with the exception of them saying we're staying the course until we get inflation under control. And I think they've done a pretty good job with that. And I think the way that Powell did his messaging at Jackson Hole, it was short, it was deliberate, it did not change course. And I think the market has to work with that. I think if other outliers in terms of geopolitics and supply chain and COVID lockdowns again in China, to me, that is, the Fed can't control that. Interest rates is one tool to fix the global inflation that we're looking at.
Yes, absolutely. And I mean, that brings us to the question that we're all thinking about, all traders and investors. We're all thinking, well, how big are they going to go, right? They said it's going to be a larger than normal rate hike. So pretty much every single rate hike they've done so far has been 50 basis points. Does that mean they're going to go to 75, or are they going to go the 100 basis point move in this September's meeting? What are your thoughts on this?
You know, it's so interesting, and I think we saw this with the data we got last week and this week, that good news, like in terms of employment and so forth, is digested by the market as bad news. So we're back to that environment where good news is bad news. So perhaps if they were to do 75 basis points, which you think would be bad news for the market, it might be a good thing because you're just getting it out of the way.
Yeah.
And that's kind of how I interpret it. So if they stay the course or move higher, I don't think the market will take it in that bad of a stride. Again, a lot of this has been so reactionary because prior to August, all the moves before were interpreted as positive. And that was because it took the Band-Aid off and they started raising rates.
Yeah, absolutely. That brings us to the last talking point of today, which was Nvidia, right? So the U.S. government has restricted chip sales to China. Obviously there's a big concern about China's aggression towards Taiwan. Do you think that this is in response to China's aggression towards Taiwan? What do you think the overall effect to the entire chip space of the U.S. cutting off its chip sales to China? I mean, obviously, specifically NVIDIA.
Right, we have NVIDIA, we have AMD. There's, the semi space in general. I think the ETF was down over 2% today. But these high-level chips are all for intelligence gathering. They're all for surveillance. We're kind of like in this, not Cold War, if you will, but for being the primary spot when it comes to advanced technologies. That's kind of what the U.S. and China are battling out here, if you will. And China relies on Taiwan for the manufacturing of its more advanced chips. They can manufacture on their own, but their more advanced chips come out of Taiwan. So we have our presence in Taiwan. We're sending our highest level politicians. China responds. Now we're going back and forth with the chips here. So there's a lot of nuances. It isn't just about the technology, but it's also about the politics behind it as well. And that's really what makes this challenging. And all of us are so used to operating globally. We're so used to the Internet of Things, everything tied together, that I think this is almost as painful as if an actual shot was fired, if you will.
Absolutely. It's sort of a trade war that we've gone back into this trade war scenario. Well, let's jump right to the charts and take a look at what's going on in the markets. And I'm going to bring up my Dash Trader to do so.
Yeah, and it's interesting. We can take a look at the SPY, we could look at QQQ, we could look at the diamonds, but I would imagine that with the subtle changes in it, the patterns are going to look somewhat the same.
They all pretty much look the same. The market is trading together at this point. So I did put a little bit of marks up on this chart. The first one that I'm going to be talking about is this is the SPY, which is the representative of the S&P 100, and I marked off this rectangle here to show the entire move up of the summer rally. And we made a significant move up off of the low that was established around, I guess it was the middle of June into July. We rallied significantly up, and we continued into the first 2 weeks of August, and then we pretty much in 3 days wiped out all the August gains, had a very sharp, very short-term rally into the moving average, and then obviously wiped out all of the August gains, going negative for August, and now we've entered into September. Usually what happens in a situation like this is you'd have a retest of the low that was established in the initial move down. And very often we would say technically that when you have a move down, the opposite direction would be the fade up. And then usually the beginning of the year was a move down. We have summer, which would fade up, and then we'd have a secondary move down into the end of September, into October, which are traditionally the two biggest, most bearish months of the year. What are your thoughts going into September and October when we know that there have been other crashes that have happened, namely 2008? We had a big crash going into September.
It's so interesting. When I look at your charts, it's that old adage that we have. Stairs up, elevator down.
Absolutely.
Right? It's almost like you have that vacuum at the bottom, particularly in volatile markets. And again, we haven't had a prolonged period of this, so it's really interesting to see how newer traders are digesting this. And I'm sure we hear about it all the time when you're educating traders in the DAS room. But September, out of all 12 months, is the most volatile, followed by October. And I think we have such a confluence of fundamentals, whether it's interest rates, geopolitics, Europe with their nat gas issues that's going to occur over the winter. We're kind of in the vacuum where there's no earnings now either. September doesn't really have the earnings momentum behind it. So I do think you'll see more chop because there's really nothing else to focus on but those kinds of headlines.
And we have New York going back to school this next week, and we have people coming back to their trading desk. We always used to joke around the trading desk. You have the top trader who's running the desk, but in summertime, it's kind of like the other guy. It's like not the top trader. And he's just
Yeah.
kind of watching. He's like, don't do anything until I get back. And he's going to wherever he's going to on vacation. So now all the top traders and top hedge fund managers are coming back from their summer vacations. And they're going to be looking and rebalancing things.
Yep. And we have midterms coming up in the beginning of November here
And
in the US.
uncertainty
Right.
is never a good thing for the markets. We have a huge midterm election where we're expecting potentially a change in Congress, where potentially the Democrats can lose control of the House of Representatives and the Senate. So, I mean, that is a massive political kind of uncertainty that's out there. The next one I want to take a look at, which obviously we're here at the Nasdaq market site, so we got to take a look at the QQQ, which is representative of the Nasdaq. And the previous low, you can see it here at 269. That is the previous low. We've pretty much, I mean, we have a head and shoulders pattern. A lot of times people knock head and shoulders patterns as like not really effective, but every major market tumble and sell-off has generally come from a head and shoulders pattern. And we have somewhat of a neckline break. The big question is whether or not we break the low that was established last time.
Right.
I mean, it's pretty much, to me, it seems like it's highly likely that we may go down and revisit that area. And in doing technical analysis, it's all about a question of degrees. How far do we go? Do we go all the way down and touch the low, or do people anticipate and buy beforehand because they don't think it's going to get all the way down there?
Right.
Or does it go all the way down there, touch
And then
the
break
low,
further.
and then break
Right.
further and wash out, and then
Right.
the floor falls out. So we don't know exactly what's going to happen. So what we need to do is just watch and measure and see how it reacts as it gets down there near the low. The last one that I wanted to take a look at was just because we very often don't look at the old man.
Gold.
Gold, yes. A lot of people forget gold because in inflationary times, let's see if I'm typing something wrong here.
Yeah, but it really is interesting. And I know we talk about gold as an inflation hedge, but the movement that we've seen in the dollar as well, I'm surprised that we haven't had a larger commodity conversation around that, because we know what higher dollar means for the commodity space. But it seems as if the conversation around that has been somewhat muted as we're thinking about commodities in terms of input costs and so forth. You really haven't heard as much about the GLD trade or the gold trade as much as we might have been talking about crude and nat gas.
Absolutely. Here we go. We're just coming up now with gold. Gold is generally an inflation play, right? It's a contrary to the U.S. dollar play. So whatever the
Right.
U.S. dollar is doing, gold tends to trade inverse to the U.S. dollar. Obviously, the U.S. dollar is now the world's reserve currency for however long that lasts.
Looks as if your windows, we can see out of a corner. Some more behind the scenes stuff here. I wish I had a little camera we could show everyone of it reloading, but you know, these are complex applications. So while we're thinking about GLD, on the flip side, when we were talking, you know, about Bitcoin in its infancies, about being almost, you know, the digital gold or an inflation hedge, I think those narratives have largely played out as, you know, digital assets in general are being thought of more around the technology that they're built on, and, you know, the different ways we can use them for transactions and revenue streams versus the actual levels that they're at. So it's just interesting to see just how much like the gold and the Bitcoin narratives have evolved around each other.
Well, we finally got our gold chart up here, and it looks like on the weekly, gold has kind of come back into an area of double support. It's gone through the previous level of support, which is telling us that possibly it's a little bit more bearish. Potentially that's a stop run from the prior support. Usually gold would bounce off of these levels. So if there was a steep rally in the U.S. dollar, a sharp rally in the U.S. dollar, that would be very negative for the markets, and that
Right.
would be very positive for gold. And that is indicating that we might be at a key reversal point, that gold has kind of gone through the previous support level, and now we would just want to see it to kind of sharply reverse and bounce to the upside.
Well, let's take a look at GBTC since
Yes.
we've been talking about it. It's certainly a hot topic with, you know, virtually anyone.
So here is GBTC, and I got to kind of zoom in because it's down so much from the highs. But so we were saying that Bitcoin was talked about as digital gold. Nowadays, Bitcoin and Ethereum pretty much trade with technology.
Right.
They've actually been trading relatively weaker to technology than you know, really they're far weaker than any technology has been in the past. And we just had obviously all kinds of news, you know, with all kinds of concerns over the security
Right.
of some exchanges.
But what's interesting about it is, and the reason I brought it up is, it's moving along it's moving beyond the narrative of digital gold and inflation hedge and so
Yes.
forth, because I think what the key narrative in the digital asset space is the underlying technology and what it allows to do in terms of business transacting, cross-border payments, sources of revenue stream. You and I have spoken about before, we tend to think very US-centric.
Yes.
So we think about, where Bitcoin and Ethereum and everything is trading, but from a practical application perspective, they are being applied in other areas around the world. So to see the separation from Bitcoin and gold, in my mind, while there might be some short-term pain, it shows that this space could potentially be maturing because it's developing its own narrative.
And also just realize that Bitcoin had a tremendous amount of hype,
Right.
And Ethereum had a tremendous amount of hype, right? Everybody was barreling into it when times were good. Now it's kind of coming back to reality. And, people are using it for its useful purposes, its
Right.
actual use value. So the fact that it was at 67,000 and now it's pulled back significantly from there, it was kind of a little bit of, I hate to say it, but like tulips, right? Like the tulip craze of the 1600s. People kind of got a little bit ahead of themselves. Now we're focusing on what it really is,
Like its utility,
what its real utility value is, versus just using it as a store of value. And there are countries in the world like Venezuela, like Argentina, where people actually use it.
Southeast Asia, that's how they transact their cross-border
That's how they
payments.
transact business.
So, Mike, I want to wrap up with Nvidia here because we
Yes.
spent, a good portion of time talking about it at the top. So, from we can conjecture what it might, what might happen to it from a fundamental perspective. But when you look at the charts,
it's in a downtrend.
Right.
Massive downtrend. And they always say that, at Technical Analysts, we say trends don't lie, right? This is a stock that the trend is down. The entire tech sector, and specifically the semiconductor sector, has been the key point where these supply chain issues have hit home. Obviously, Nvidia and all the chip sector were beneficiaries of the Bitcoin, Ethereum craze and the Bitcoin mining craze, and everybody was buying graphic cards, expensive graphic cards to do their mining because that's what they used to do it. So I think they were very much the beneficiaries of that craze. And now again, just like Bitcoin and Ethereum, they're coming back to reality. But on top of that, you have geopolitical concerns and you have a real supply chain issue. And these plants are not easy to build, right? Like you can't just go throw up a plant in Arizona and have it ready in 6 months. This is something that takes a long time. This is going to take a year or two or maybe even 3 years to get their supply chain issues, relocate assets, et cetera. So I think that, for the short term anyway, this downtrend is really well-deserved.
But it even goes back to what we were saying initially in the beginning, like with interest rate hikes and cycles and so forth. It does take, a measure of patience. Same thing, the market sometimes moves faster than factories can be built, or until you're able to quantify the fruits of your labor and the capex that you're putting into the company and unforeseen costs that come up along the way. But I just feel like we've been so conditioned to point and click or make a profit like that, and a measure of patience does have to be exercised.
See, this is exactly the case.
Right.
Hedge fund managers and traders, they don't want to park their money here. The trade is done. Right. Now we got to wait for reality to catch up to where their money wants to be. So they're going to take their money and they're going to move it somewhere else. And that's what's creating this downtrend. The markets are always forward looking. Traders are always on to the next thing. So they're already pulling their money out and going somewhere else because they're like, oh my God, we're going to have all these problems. They're not going to make money from China the next couple of times. So traders and investors are already moving on. And that's being reflected in the chart. The chart lags reality a little bit, but reality in some ways really lags what traders and investors are doing. We're already on to the next thing, and that's showing in the charts. And yes, it's a downtrend. It's probably more traders and investors. Probably retail's the last to get out. They're going to be left holding the bag, as usually is the case. But if you haven't gotten out of Nvidia, it's probably not going to see a lot of upside in the short term. Now you might get a pop here or there, but at this case, it's a downtrend, and it's broke the prior low. And that's a little bit of as a trader, that's not some place that I would want to keep my money at the moment.
All right, Mike, I'm going to let you take us home. I'm going to sit back and enjoy the view, and
absolutely,
you get ahead and do my job.
Much. I'm going to just transfer my screen share right back to my original presentation. So this is the competition announcement. So the dates have been announced. DAS is teaming up with Nasdaq once again for our swing trading competition. Registration for the boot camp is on September 5th to October 2nd. There's a $50 early bird discount right now. The competition runs for 20 trading days from October 3rd to October 28th. Prizes include up to 9 months of Dash Trader platform for free. All winners will receive a keepsake photo at the Nasdaq ring podium here at the Nasdaq market site. We're also going to be having a tour of the Nasdaq market site. Myself will be there giving the tour, and I believe you'll get to meet Jill as well if she's here. So stay up to date with all things Dash by signing up for our monthly newsletters and our emails from our website at dashtrader.com. Subscribe to our YouTube channel at Dash Trader TV, and our social media links are as follows. We have LinkedIn, Twitter, Facebook, and Instagram. Thank you so much for joining us this time from the Nasdaq market site here in Times Square. Jill, thank you so much for being here with us, and I hope to come back soon to do this again because this was really incredible.
Pretty incredible.
It was great. Pretty amazing.
It is, and it's
location.
always a great thing to talk when you think about consumer spending, the economy. That fishbowl that we see out there.
That's exactly
when you
right.
see it really busy, that's always a good sign.
And it's good to see it's busy. It's fairly active. It
Yeah.
seems like it's back.
All right. Well, we look forward to having you back. Thanks so much.
Thank you so much, Jill.